to it, just like you said. And what that means is that you have a lower interest rate to begin with, and your interest rate is fixed for a short period of time, either 5 years or 7 years or 10 years. So you're getting a below market rate. It's very good for people that are in a house short term, or for people that know they're going to make more money today than tomorrow and they want a lower payment up front. Then there's an anniversary date. And the anniversary date, at the anniversary date, what happens is that mortgage now becomes a adjustable rate mortgage, and the payment will change on that anniversary date once a year, every year, according to the market standards. Now, right now, I will tell you that I put my daughter into an adjustable rate mortgage 14 years ago in her house. She still has that original mortgage, and her interest rate is 2.75%.
And so let me kind of clarify how that works. So you lock in an interest rate. Let's say a 30-year fix is what, 3.75?
4.25 today.
Four and a quarter on a 30-year fixed. A 5-year ARM is going to be
3.5.
3.5. So you're saving 0.75% in interest. That interest rate, that 3.5%, is locked for 5 years, and every year after that, it can adjust up or down.
Correct.
And we're not going to go into the details, but it's based off of different Treasury indexes, either the U.S. Treasury Index or what's called the LIBOR Index, which is England's version of our Treasury Index. That is what sets and determines that interest rate every year. So it's an adjustable rate mortgage. It's fixed for a certain period of time up front, and then it adjusts every year thereafter. And like Kelly said, this is for people who either A, are only going to be in the home for a short-term period, not more than 5 or 7 or 10 years, or B, someone that is looking to have more earning and income down the road to where maybe right now a lower interest rate is affordable, and then they can get into something on a fix or something down the road, right?
You're correct.
So there's your fix versus ARM. Now, what's a prepayment penalty, Kelly? I've heard about these, and when the mortgage bubble burst and you had all these negative loans and these subprime loans, what's a prepayment penalty mean?
A prepayment penalty was instituted because a lot of mortgages were being flipped or they were being paid off very quickly. And when that happens, basically the industry loses money. And the industry loses money, then our rates and fees go up. So that wasn't a good thing. So a lot of lenders instituted a prepayment penalty. Right now, your FHA, your conventional conforming, your VA, they don't have any prepayment penalty. So the borrower doesn't have to worry about that particular program. It hasn't really been around for a long time.
You know, so the prepayment penalties aren't as prevalent as they were with all these other unorthodox, not very consumer-friendly mortgages that were out there. So there's not a lot of prepayment penalties. That's something else to be aware of. Okay. Interest rate versus your APR. And I'm going to try to help Kelly along with this because this is just such a difficult thing to wrap your head around. So you have your interest rate. On a 30-year fixed mortgage, it's 4.25%. That is the interest rate that you pay for the full 30-year term of your mortgage. Locked and loaded, that's your interest rate. Then you guys see, and you see it on a commercial for a credit card or any other loan, that it'll give you an interest rate, say a 4.25%, but then it says the APR is 4.5%. It's higher than the interest rate. And you're thinking, well, which is it? What am I paying? Am I paying a 4.25% interest rate, or am I paying this 4.5% APR annual percentage rate? And the answer to that is that you are paying the 4.25% interest rate. The APR is something that is required by national banking laws to basically take into consideration any fees or costs that are associated with obtaining that interest rate. And we can get really meticulous into it. We're going to leave it as simple as, what fees are you paying to obtain that interest rate? The more fees you pay to get that interest rate, the higher your APR is going to be versus your interest rate. So that's a way when you see an interest rate of 4.25% and then an APR that is significantly higher than that. And again, this can be a commercial for a credit card or a car loan or a student loan. That means that APR is considering what it costs to actually obtain that interest rate. Is that right, Kelly?
That's correct.
Pretty simple to keep it that way. So then last thing we're going to kind of talk about when obtaining a mortgage are points, right? I think every mortgage is going to come with some sort of an origination point. It's basically how the mortgage company earns income off of the mortgage, is by charging a fee to process the loan, to originate the loan. Now, there's other fees that can come along on a mortgage from a mortgage company. Another term is called a discount point, or a discount fee. Then there's also fees like an underwriting fee, a document preparation fee. And let's just call it, sometimes lenders can camouflage fees to make them sound like they're necessary, but in essence, all they're doing is charging you more. Right, Kelly?
That's correct.
And so when you go with Kelly McCurdy and C&N Mortgage, they are very straightforward. And anytime you're looking to get a mortgage or a loan or a car loan, you want to see the fees broken down, what you're paying to obtain that loan. Because a lot of mortgage companies might tease you with a low interest rate, but be charging you thousands of dollars to get that interest rate. And that takes me to a very important point. When you're getting pre-qualified for a mortgage, that mortgage company is probably going to give you what we call in the industry a teaser rate. It's probably not the legitimate interest rate that if you had a home under contract that they would give you that day. So oftentimes they might say, hey, the rate's 4%, and the next week when we actually go out and I help you find a house, we go under contract, we go back to your mortgage company, and they say, oh, that rate's 4.25%. Well, what happened? One of two things happened. One, either rates went up, or two, that mortgage company was teasing you with a lower interest rate than they could offer you initially to get your business. And so that's very important, you guys. When you're refinancing a mortgage or buying a house, once you have that home under contract, that's when you go and get that interest rate and the closing costs in writing, and you want to shop it around. Give Kelly McCurdy a call, 602-615-4881, and get a second or third opinion on the fees and interest rate you're being charged on a mortgage. I see it all the time where someone tells me, hey, I got pre-approved with this company. They've got this super awesome interest rate. A week later, we find a house, and that interest rate is nothing close to what they had been promised. So that's an important point to touch on, right, Kelly? Because a lot of these mortgage companies on their commercials have these super low teaser rates that you hear of.
Yes, if I had a friend or family member coming to me and maybe in another state that I wasn't lending on, and they asked me how should they evaluate or compare mortgage companies, I would say go to your institutional bank and see what they're offering. Sometimes they have some good things to offer, and sometimes they're out of the market. I would go to a reputable mortgage banker and get an estimate from them. And then I would kind of, maybe sometimes, look online, see what the rates are. But remember, the rates online, if they're not, teaser rates like Logan explained or lower rates, you're not going to pick up the phone and call. So the online usually should be used more for a reference and shopping because, again, they're all about volume. They're big box, They're the Walmart of the mortgage industry, and it's not as much customer service oriented as a local lender that specializes in your market and works with the local real estate community.
That's the point I wanted to drive home. Oftentimes I get someone that says, yeah, I got this pre-approval from XYZ mortgage company in Oklahoma. I would really prefer you to use one of my local mortgage experts who knows how local real estate works. So it's very important to go with a local mortgage expert and a professional. And all right, we're moving on. We're going to take a quick short break, and the most important part of the show, we're coming right back to talk about, hey, I had a foreclosure 3 years ago, Kelly. Can I buy a house now? Or I had a bankruptcy 4 years ago. Can I buy a house now? We're going to go over all of these truths and myths and tell you listeners exactly what these anniversary dates are from when you may have had a financial shortfall in the recent past and how quickly you can qualify for a new mortgage. Stay tuned to the short break. We'll be right back. Thanks. I'm here with the best mortgage guy in Arizona, Kelly McCurdy, talking about the truths and myths and short sales and foreclosures. Kelly, tell our listeners some good news.
Hey, Logan, we're so excited to announce that we can provide a client with an FHA mortgage 3 years after a foreclosure, 3 years after a short sale. And for our VA clients that probably served our country, we can provide them with a mortgage 2 years after a short sale and 2 years after a foreclosure.
Wow, that's awesome. Give Kelly McCurdy a call, 602-615-4881. Again, 602-615-4881 to find out how, and tell him Logan sent you. All right, we are back for the last part of the show, and I'm going to probably say the most important part of the show. We're here with Kelly McCurdy with CNN Mortgage, and we're going to talk about right here are very important things to know. If you're like myself, which many of us are, I got caught with a few houses, a primary residence and a couple investment properties in 2006, 2007, 2008, when everything kind of went south. So I've got a couple of black marks on my credit with some short sales and foreclosures and such. And the important part about what we're going to share with you right now is the bright side of those things, that right now where we're at, it's kind of working itself out in the cycle. We're in that 2, 3, 4, 5 year time frame of when people had fallen on financial hardships and had to make a difficult decision to either short sale, foreclose, or even claim a bankruptcy, which, hey, we've all been there. We've all had to do that. We got to do what's best for us and our family and moving forward. So what we're going to kind of talk about are the exact years out from a short sale or a foreclosure or even a bankruptcy on when you can purchase a home. So let's start with the FHA loan program, which is basically the low down payment program we were talking about. So, Kelly, it shows right here that if you had a foreclosure 3 years ago...
3 years.
See, these truths and myths, 5 and 7 years is what I've heard. So if you had a foreclosure 3 years ago, you can go out and get an FHA loan right now.
You're correct.
A VA loan only 2 years out from a foreclosure.
Correct.
What? What happened to these 5 and 7 years that everybody was hearing? There's not really on there, okay? Now, on a Fannie Mae or a conventional loan, they're a little bit more stringent. There's that 7 years out.
You're correct.
On a conventional loan, if you had a foreclosure, it's 7 years out. So I want to reiterate, FHA 3 years out from foreclosure, VA 2 years out from foreclosure. How about a short sale, Kelly? Looks about the same thing on a VA, 2 years out from a foreclosure or a short sale.
Correct.
Same thing on an FHA, basically, right?
Yep.
So regardless if you have a short sale or foreclosure, 3 years now you can go get an FHA loan. 2 years, if you've proudly served our country, you can go get a VA loan. And on a conventional, it's 4 years out from a short sale. Wow.
Yes, 4 years.
All right, let's talk about BKs, which is basically the worst mark you can have on your credit. That is saying, I'm throwing in the towel on everything. I got to start from scratch because I'm about to drown. I got to get my head above water.
You're correct. The foreclosure is the worst time frame on your credit, but the BK will affect your credit score the most.
Absolutely. So it's important to point out there's two types of bankruptcies. There's a Chapter 7 bankruptcy and a Chapter 13 bankruptcy. A Chapter 7 is basically where you worked it out with the courts and the bankruptcy judge that you're not responsible to pay back any of these debts that they are clearing from your credit. A Chapter 13 bankruptcy is where that bankruptcy judge has determined that you do still owe and are responsible for some of these debts that they're trying to wipe off of your credit. So you got to delineate between the two.
Yeah, it's like basically like a Chapter 13 is like a payment plan. Mm-hmm. You know, if you owed $100,000, the judge tells them to take $20,000 and you make those payments over 3 to 5 years.
A Chapter 7 is, hey, you owe him $100,000 and the judge says this guy can't pay him. Sorry, people, you're not getting your $100,000. Write it off as a loss. So on a Chapter 7. From a bankruptcy, you guys, for FHA, 2 years.
Yep.
VA, 2 years.
Yep.
And on a conventional, 4 years on a Chapter 7 bankruptcy. Gosh dang, these are a lot less than I thought they were, Kelly.
And the time goes by fast.
It does. And then for a Chapter 13, it's even less than that. 1 year on a VA, 1 year on an FHA, and 2 years on a conventional. So,
well, actually, let me clarify that on the FHA, Logan, on the 13. You only have to be in it for 1 year and have 1 year's payment history. You can be in the Chapter 13 repayment program and get approved for a mortgage.
That's phenomenal.
Or once it's discharged, meaning that you've completed the program, then you can get an FHA loan the next day.
So I'll tell you what, you guys, they've really helped us out over the last couple years trying to make this a little bit easier for those of us who have fallen on financial hardships over the last few years. So I think it's very important, again, to get in touch with the local mortgage expert. Kelly McCurdy is one of my top guys. And I think the takeaway from this is to get a copy of your credit report pulled, right, Kelly? And you hear all these commercials about Credit Karma, freecreditreport.com, blah, blah, blah. None of that is free. We understand that. And I also know that those credit reports aren't as comprehensive and detailed and thorough as a credit report that you're going to pull for somebody. And I wanted to reiterate, you provide free credit reports, Kelly. Is that correct?
We provide free credit reports, and we also have a special service that we pay for that you'd pay as much as $100